If you use a 1 minute or 5 minute, do the concepts I teach you work. The concepts work in every single time frame. I've said this over and over and over again. Every trading technique or tactic that I teach you is applicable in every single time frame. I don't pick one. 1 minute, 30 seconds, tick chart, 5 minute chart, 2 minute chart, hourly chart, 30-minute chart, daily chart, weekly chart, monthly chart. Doesn't matter. Every time frame. And also every market. Now, let's cover some real times. Let's cover some real signs, right? Sign number 1, 200s are back to being respected. But I mean, not just with one stock, all over, right? So you see it prevalently. Like, we could take a look at Apple, respects the 200. You can take a look at Facebook, remember the 200's an area, respects that 200. You can look at BABA, remember the 200's an area. It's not a line, it's an area, it's a zone. Respects that 200. You know, nothing is ever 100%, but we're talking the majority of times. We can take a look at Square, respects that 200 zone. All right. So you get the point. AMD, it's all over. It's all over the place. So that's one sign, which I think is important as well. Another sign is solid declines start to adhere to the normal, what should I say, the normal percentages. So sign number 2, see the solid drop? Look at the bounce, all right? It's 1/3 to 1/2, right? 1/3 to 1/2 bounce, boom, resume. So look, drop, 1/3 to 1/2, boom, 1/3 to 1/2, boom, 1/3 to 1/2, boom. So you get, it's never perfect, but you start to get the respect of those percentages again, you see? The respect of those percentages again. It's hard for the stock to get past, though you'll always have exceptions, but you'll see this just across the board. Look at the bounces. There, you see? Now, things look like they're going to try to squeeze about halfway back up here. So sign number 1, 200s become a lot more reliable. Sign number 2, strong moves down, keep their rallies back to the upside in check. Okay? In check. 1/3 to 1/2 most of the time. Most of the time. Right? Nothing's ever 100%. Decline, rally, stays in check. Decline, rally, stays in check. Okay? Now, of course, when you start to get spaces, you can potentially get a little rest. You all know those concepts. Look at this. Sign number 2. I want to show you. Sign number 3. So sign number 1 is 200s. Sign number 2, percentage bounces after strong moves down. On by and large, stay in check. Sign number 3, frequent GBIing. So remember when we had the crazy bull period, it was like RBIs were just all over the place. You get power, pause, power again. Power, pause, power up again. So we got a lot of this. Power, power, pause, power, pause, pause, power. So we got a lot of this going on when it was crazy. All right. Well, you get a lot of that now in reverse on the down days. So, you know, you get power, power, pause, power, pause, power. See, they're brief little pauses. Power, pause, power. So you see a lot of the power pause across a lot of things. So here's PayPal, here's Square, and look at your pauses, but doesn't abrupt the power. You see, that's sign number 3. Sign number 4, gaps are respected with more regularity. You know what you're supposed to do with your gaps is you're supposed to fill them in, right? To the open. So here's the open. So you get this, boom, the gap is respected. It's not completely just taken out. We've had some takeouts this morning, of course, but on average, you start to see more of your gaps get to the open, respected. So the bounce into the gap, and then the resuming of the gap. That's where Betty got into the play. Like guys, how pure is that? That's the 5-minute chart, by the way. So you got like 2 tails into the 200 and then a clearing elephant off of the 20. Like, you're not surprised that this went like that. Why? Because it's a pure signal. All right. But I think she took it off the 2. Here's your tail zone, right? You drop. You come back into the tail zone and produce another tail. Like, are you kidding me? But okay, you missed that. No problem. Look at this clear signal. Look at this. Like, look how pure that is, guys. Isn't that pure to you? Do you see that as pure? Right? What if you could just wait for the purest of signals? Okay, I'll ask a different question. How many of you have written down the purest signals? But what if you could do that? What if you could just say, look, these are the 4 purest signals? All right, so yeah, shall we do that? You guys want to do that? Or we can leave that for another day if you like. Yeah, you want to do that? Okay. You sure? Okay. A surge, right? A surge off of a key moving average. All right, so it can be the 20, it can be the 200. So this would qualify. A surge off of a key moving average. This way or this way. Now, it doesn't necessarily have to touch. Remember, moving averages are more like zones, so as long as it's close. So you see how this is a surge off of a moving average, right? Now, take a look at let's look at the 15. Well, let's look at the 5. You see that surge off of a key moving average, right? Look at this one. See this one? You see that? Off of a key moving average, right? A surge off of a key moving average. There's no surprise that that worked. There's no surprise that that worked. So that's item number 1. But I want to show you again. I can show you another one here. If we go to the 15-minute, you see? This is one where it don't require that it touches, just near. Surge off
of a key moving average. There's no surprise that works. Dual tail bars. Dual tail bars. Boom. This goes both ways, guys. Back-to-back tail bars. All right. They're a little separated, but those work too. But topping tail bar, so you're in a downtrend, pull back and topping tail bar right into the declining 20. Boom. GBI. Boom. GBI. Boom. Pull back. Boom. Crazy, right? And also, when there's institutions can't dump the market. They can't dump on the market, right? All at once. So imagine if you had 88,000 shares of a stock. I mean, that's not uncommon. 88,000 shares. How do you pare down? Do you dump 88,000 shares? No. You systematically put your orders through an algorithm. And that's what you do today. And so your sell orders might be, I'm going to sell 412 shares every 30 seconds. And you run that algorithm for days. And guess what that produces? This. You see how clean and steady that is? That's institutional liquidation. That's systematically coming out. That's not dumping on the market would be like that, you see? Now, there are moments of panic when that happens. March 2020, things like that. Like there are panic moments where you will see dumping. But when it's not panic and it's more like we just have to pare down, you see it steady. Just steady bleeding, steady liquidation. This is what institutional liquidation looks like. That's the picture. You want to see it, really clean? You want to see how really clean that is? We go to the 15-minute and look at look at how clean. It started yesterday. It's just freaking systematic liquidation. That's algorithmic liquidation. Now that algorithmic liquidation period is a boon to us because all we have to do, right, is find a moment to get in, boom, topping tail bar, declining 20 or GBI, and then you sit back. Like you don't focus on the bars, you focus on the moving average. The bars might trick you and get you out. The moving average won't. Look how smooth the moving average is. Like there's not a freaking wrinkle in that moving average right there. All right. Now, what moving average should you be using? This moving average bounced off of the 20. So the 20 moving average is the key moving average until you get the next pullback, right? And then you see this pullback and boom. Now is it the 20? Should you be using? Do you see what I'm saying? No. I would say go to the 13. Let's try the 13. You use the next pullback to determine which moving average you flip to, right? Guys, where would you get these things without me? There it is, 13. Boom! Well, damn, Oliver. How'd you know that? All right. So it was the 20. After this pullback, now you revert to the 13. And you stay with that until the next until you either break or the next pullback reveals something milder. Maybe you go to the 8. You guys got that? You understand that? A few of you let me know. Paul, you understand now? Because you were asking me. You understand that now, Paul? You understand why we use the 13 now? Yeah, well, I'm improving on Dr. Dan and Paul's right now, Muhammad. I'm giving you an extra moving average to use, which is at the 13. Because the 8 would have knocked you out here, right? Okay, so you don't want to get knocked out. So, guys, your moving average, right? Your moving average is determined after a pivot. So you see, this is a pivot, right? Pivot, drop. You need the drop to know that that's a pivot. So now you know it's the 20. And so you see this pause and then drop. Now you know it's the 13. You can't anticipate this. You know it after what to revert to. So now we have now tightened our stop to the 13. All right, this is still confirmed the 13. Doesn't have to touch it, just be close. Okay. And remember that these moving averages are more like rubber bands or fences that have leeway, or boxing ropes that you can lean against. This is not breaking the 20. That's leaning against the ropes. Right? So don't take every little violation as a real break. It could be just leaning against the fence, but not breaking the fence.
The tactics that I teach you are rooted in the psychology of market participants. And the psychology of market participants is driven by two dominant emotions, right? Fear and greed. Fear and greed doesn't just disappear because you change a time frame. Oh, wait a minute. I'm trading the 2-minute. Let me switch to the 5-minute where fear and greed doesn't exist. No, it exists there too. And just because you switch from one market to the other doesn't remove fear and greed. Fear and greed is in every market. Fear and greed is in every time frame. And all my tactics do, guys, all my tactics do is teach you how to identify when does fear, boom, 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 stop, and greed begin. There's a moment where fear stops and passes the baton to greed, and greed starts running. And then greed runs its race, and then there's a moment where greed gets tired, I'm tired, and passes the baton back to fear. And fear takes the baton and runs its race. All my tactics are designed to do is to teach you how to identify when are both fear and greed, when do both of them have the baton? Do you understand this? There's a moment where fear and greed both have the baton. That split moment of transition. Tell me you understand this. There's a moment where fear stops and greed takes off, but there's a moment where the baton is in the hand of fear and greed takes the baton. There's a moment where both, it's ever so brief, have the baton. Boom! I teach you how to identify those moments. Do you understand? And those moments exist in every time frame and in every market. Someone's asking me, do the narrow and wide concept, the concept of a market being in a narrow state or a wide state, is that in the Indian market? Listen, I'm going to say it again. My concepts work in every time frame in every market on planet Earth. I don't know about markets in another galaxy or on another planet. All right. We have yet to do intergalactic travel, right? I haven't done that yet. So what I'm telling you is that if it's a market on planet Earth, it works in that market. All right. Period. Indian market, Chinese market, American market, German market, UK market, every market. That's like saying, do Indians inhale and exhale too? Because that's all you're talking about when you're talking about a narrow state and wide state. The market is inhaling and exhaling. It inhales, it goes low volatility to wide volatility, low volatility to wide volatility. Every mechanism in life has these two states, right? The market is no different. Now, I think it's important to understand this, that people confuse the fact that they confuse this fact very often. They think a market has a life of its own. No market has a life of its own. The market is only a reflection of the lives of its participants. Like, for instance, if no human being showed up, would the market move? No. You understand what I'm saying? Or if no human being showed up, or no machine that a human being created was turned on, the markets wouldn't move. Do you understand this? So the market doesn't have a life of its own, which means that its life or movement is really driven by the activity of its participants. And the activity of its participants is driven by two dominant emotions, fear and greed. So at the end of the day, you're not trading the market, you're trading people. And more specifically, you're trading the interchangeability between fear and greed. That's all you're trading.